Hi, good afternoon and welcome to the Foundation for Teaching Economics webinar, 26 trillion and counting. What is our debt capacity? Today's talk will highlight federal debt policy in our current era of low interest rates. I think a very relevant question as our country deals with the COVID-19 pandemic. I'm Ted Tucker, Executive Director of the Foundation, and it's my pleasure to introduce our speaker today, Dr. Louise Sheiner. Dr. Sheiner is the Robert S. Kerr Senior Fellow in Economic Studies and the Policy Director for the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. She has also served as an economist with the Board of Governors of the Federal Reserve System and was a senior economist with the Fiscal Analysis Section of the Research and Statistics Division. In her time at the Fed, she was also appointed Deputy Assistant Secretary for Economic Policy at the U.S. Department of Treasury and served as a senior economist with the Council for Economic Advisors. Dr. Sheiner was a presenter at our November 2019 Washington, D.C. Federal Budget and Deficits and Debt Policy and Practice Program, and I'm grateful for her giving today's presentation. A recording of this webinar, along with Dr. Sheiner's slide deck, will be posted on the FTE website a day or two following her presentation. We ask that you use the Q&A feature to answer questions, and you can upvote those questions. She'll be presenting for about 45 minutes, and we'll have about 10 to 15 minutes for questions. Having said that, Dr. Sheiner, would you like to take over?
I'm going to apologize. My dog is barking a little in the background. Hopefully he'll stop in a second. Well, thank you very much for having me. I'm really glad to be here. I was really had fun talking to this group last year, and I'm glad to be doing this in this virtual format today. I'm going to share my screen. And put it in slideshow mode. So today I'm going to be talking about the fiscal policy response to COVID and the long-term outlook for the federal budget and the relationship between the two. So let me just start off by talking a little bit about the economic consequences of the pandemic. So this pandemic it caused a recession quite unlike any other. Most recessions are going to be caused either by too little demand or a bubble in some part of the economy. But this one was really caused by the need to confront the virus. So employment and output, or GDP, declined because of lockdowns and the need to socially distance. So what is GDP? GDP is production. When people are not working, production falls. And economic policy was not able to do much about this. If you had to stay home for health reasons, then it's a little harder for economics to sort of fight the recession. The one place where you can fight it is with public health policy, testing, tracing, encouraging masks, keeping bars closed, to minimize the need for lockdowns and social distancing. So what happened in the spring, in the second quarter, which is April, May, and June, GDP fell about 9%. Right, that's the level of GDP. If you read about it in the newspapers, I'll say GDP fell at an annual rate of 31.4%. The way we do report GDP is that would be what would happen if GDP fell 9% 4 quarters in a row. Then it would be down 31.4% total. The unemployment rate went to, I think, 16% in April, and average about 13% in the second quarter. This was an incredibly rapid increase on the unemployment rate, an incredibly unseen 1 quarter decline in GDP, and it looked like it was going to be really, really bad. There was nonetheless a really big bounce back in the third quarter. We don't have third quarter GDP yet, but probably the growth rates are going to be something like 30%, maybe 35%. The unemployment rate fell to 7.9% by September. And so we got a very big bounce down, a very big bounce up. But still, the unemployment rate is about 8%. And before the pandemic, it was 3.5%. So our economy is still in very weak shape and still well below potential where it was operating before the pandemic. So what can fiscal policy do in a pandemic? I've already mentioned it can fund public health to basically minimize the cost of the virus itself. It can do things like provide sick leave. So similarly, by making sure people have the ability to self-quarantine if they're sick and they don't show up for work because they need to feed their family. It can do a lot of relief, right? It makes sure that people have enough income to eat, to pay bills while they're unable to work. And then it can also set the stage for a strong recovery, right? So the goal should be to try to limit the GDP effects to those necessitated by the response to the virus itself, rather than having additional knock-on effects. So what do I mean by knock-on effects? So if people are unemployed because they can't go to work because of the virus and they don't have any income, then because they don't have any income, they won't be able to buy things that they can buy completely safely, like buying goods online. That further weakens the economy, right? Or if businesses fail, you can imagine that's going to do some long-term damage to the economy, because even once it's sort of safe to go reopen, the businesses have to start all over. And so what really economic policy was meant to do was to say, let's make sure people have enough money during the pandemic. We're not going to get GDP back up to where it was before while people are still having to socially distance, but let's set the stage so that we can do it so that as soon as it's safe, the economy can come roaring back. That should be the goal. So what did we do so far? So we passed a lot of legislation in the spring. The biggest piece was the CARES Act. It included $1,200 rebate checks for most adults, a really unprecedented expansion of unemployment insurance. It had two major components. It increased unemployment benefits by $600 per week through the end of July. And it also expanded eligibility for people who usually are not eligible, like gig workers, people who didn't make enough money, who don't have a long enough earnings history. And that expansion lasts through the end of December. They did the Paycheck Protection Act, which is $550 billion in forgivable loans, basically grants to businesses who kept workers on their payrolls. And they provided $150 billion in relief funds to states, actually a little bit more because they also had some targeted funds for transit and for K-12 education. You know, on the whole, what was passed in the spring was, I think surprisingly good and very quick response. It was clearly motivated by that desire to set the stage for the strong recovery. It tried to get money out fast, and it tried to get it out in lots of different ways. It sort of attacked the problem from all kinds of directions. So we gave money to the unemployed, we gave money to businesses, we gave money to households, to sort of limit the amount of falling through the cracks. And also, we were trying to do things quickly. It's hard to know how well it would work, so you sort of try all kinds of things. And the unemployment insurance piece was very progressive. It's interesting, the reason they did the unemployment insurance the way they did, adding $600 per week, was what they really wanted to do was make people whole. To make people whole, what you need is what's called a replacement rate of 100%. That means unemployment insurance would basically equal your wages. This unemployment insurance is run by the states. In order to sort of program the computers to give you a 100% replacement rate, it would have taken months, if not years. These are old computers, and the basically state says we can't change the formulas, but we can give everybody the same amount. So they gave $600 to everybody, which on average was supposed to be about 100% replacement rate. But for people who didn't make a lot of money, it was a big increase in their take-home pay. So it was very progressive. So how well did it work? I think it worked quite well at first, but now we need more, right? So the UI benefits at first did take a long time to get out. Those state systems were just overwhelmed because we had really never seen such a rapid increase in unemployment in such a short period of time. But the money did eventually go out. And if you look at income in the second quarter, it actually rose, even though we had a 13% unemployment rate, because of the checks on the unemployment benefits. Now, spending fell a lot in the second quarter because people weren't spending money because they were staying home. And so saving also increased sharply. So then that means that household balance sheets are in pretty decent shape right now. And once it's sort of safe to spend, a lot of households will have the wherewithal to spend. But now for people who are still unemployed, that's no longer such a happy scenario. The extra $600 is gone. Replacement rates without the $600 are not very good. They're usually about, it depends on the state, but something like 40 to 45%, meaning that you're going to lose more than half of your income when you become unemployed. And some people will be starting to run out of unemployment soon, benefits soon. So the limits vary by state and depends on the unemployment rate, but it's about 39 weeks. And so people are still okay, but they're going to start running out. Small businesses, particularly in areas like travel and restaurants, are still not really operating anywhere near capacity, and it's going to be worse in the winter, and they have no more PPP money. And state and local governments, they did quite get a reasonable amount of aid for this year, but they're looking forward to next year, and they're going to see that the economy is still going to be weak, and they're going to need more aid, and knowing that, they're not going to be willing to spend this year. So we need more money to provide relief to unemployed people and to minimize these long-term costs of the pandemic on the macroeconomy. So one way of looking at where we are is the Congressional Budget Office, CBO, sort of projects the economy under current law. So assuming there's no more stimulus funds passed, this was their projection. This is the ratio of real GDP in their projection in July 2020 versus January before the pandemic. So this is basically the effect of the pandemic on activity, on GDP. You can see there's a very big decline and it starts to recover, but you can see that they have an extremely slow recovery and it actually never fully recovers. And still it gets kind of close to where it's going to end up in 10 years. So we've got 10 years of the economy not acting, not being very robust. And because it's taking so long, it has these long-term damaging effects on the economy where people lose their skills and businesses don't invest. And so even in 10 years, you're not back to where you would have been. But if you had more fiscal stimulus, you actually wouldn't have to have this at all. If you had enough fiscal stimulus, you could fully recover and recover much sooner. Basically by the time, or just shortly after it sort of, no more need for social distancing. We have a vaccine that's widely disseminated. With enough fiscal stimulus, we could basically get back to 100% by like 2022. Okay, so then why don't we do more fiscal stimulus? Obviously the politics of it are interesting right now, but some people would say, sorry, I forgot about this next slide, just hold that thought. One thing I think is important to remember is how good the pre-pandemic economy was. So like I said, the unemployment rate was 3.5% in February, and there were no signs of inflation increasing. That's important because typically what happens is when the unemployment rate starts to get down, the Federal Reserve to sort of below 5% or 4.5%, the Federal Reserve will say, oh my God, the economy is running too hot. We're gonna have a lot of inflation, and so let's rein it in. Well, the truth was the unemployment rate was 3.5%. The economy was generating a lot of jobs, and there was no inflation. And we were learning, and the Federal Reserve was learning too, that the economy had the capacity to operate at a much lower unemployment rate than we thought. And there were really a lot of good things coming out of that hot labor market. So it was starting to bring marginalized people back into the labor force. You heard stories about people with prison records getting job offers, disabled people coming back into the labor force, people who had left the labor force during the Great Recession thinking they'd never come back in, all of a sudden saw good opportunities and started to come back in. And some real wage growth was also starting to happen. So this was a really good thing. It was a good thing to combat inequality in our society. And so it's important to remember that's the goal. We want to get back to that economy. We don't want to say, oh, the unemployment rate's not that high. We don't have to worry about it. We really shouldn't allow ourselves to settle for anything less than that economy. Okay, so why would we might not do it? Well, what about the federal deficit? All right, so what is the federal deficit? It's just the amount that the government borrows every year. The legislation that was enacted that I mentioned increased the deficits by $2.3 trillion in 2020. That's a lot of money. We like to think about the deficit as a share of the economy because the larger the economy, the more you can sort of hold debt, the more you can borrow safely. So the deficit was 16% of GDP in 2020 and is projected to be 8.6% in 2021. This is fiscal years. So 60% of GDP is far larger than what we saw even during the Great Recession, where it hit 10% of GDP. These are really huge numbers. They're bigger than any time other than during World War II, where borrowing went, I think, to up to 30%. Okay, so that's the federal deficit. What about the debt? So this is a picture of the federal debt held by the public since 1900, again, as a share of GDP, which is the right way to look at it, sort of relative to the size of the economy and tax revenues and everything like that. So you can see that debt went up in World War I, it went up in the Depression and World War II, and the Great Recession, and then really went up a lot with COVID. So debt in fiscal year 2020, which ended at the end of September, hit 98% of GDP. That's higher than at any other time that we've observed, except for World War II. At the peak, it hit 106% in World War II. So we definitely have taken on a lot of debt, and much more than we've seen since post-war. First, we had the Great Recession that boosted our debt a lot, and then we had COVID. And going forward, the debt to GDP ratio is projected to keep on increasing. In going forward, we have sort of dynamics coming from the aging of the population and continued rising healthcare spending, right? So population aging puts pressure on federal budgets because of increases in spending on Social Security and Medicare. And then with health spending that has typically risen faster as a share of GDP, that kind of is a double whammy. So as health spending goes up, and then as we have more old people who get Medicare and Medicare gets increasingly more expensive, the debt is expected to continue to rise, right? So I said we were almost at our record from World War II. We are shortly going to surpass the World War II record. And then, under current law, this is all under current law, it's just going to keep on increasing sort of without sight, all right? So this looks bad. Is it a huge problem? So here's what the traditional, and I would say a probably dated view is. So why do we usually worry about debt? So the argument would be, well, debt crowds out private investment, right? Savers lend to the US government, making less money available to fund private investment, right? So people are saving and they say, well, I could put it in the stock market, or I could go buy treasuries, or I could put it in a corporate bond fund. To them, to a saver, it's all the same thing. But the money that the federal government sucks up is then therefore not available to private businesses. And the mechanics would be there is a lot of demand for saving because the federal government is borrowing a lot. Therefore, that sort of makes the competition for funds more intense. What happens? Interest rates rise. We try to get people to lend more by raising interest rates. When interest rates are higher, oh, I'm sorry, I see this. Could Professor share her slides for the full screen? I just noticed that. Is it not full screen?
You're in slideshow view. They're seeing the one with that shows the upcoming slide as well.
I'm going to stop share and reshare. I'm so sorry.
Okay.
How's that?
Same one. It's
the
oh,
same
there we
one?
go. You're good. No, now we're good to go.
Okay, good. I'm so
We
sorry.
only see your main slide.
Okay. Okay. All right. So, so what happens is when this is a traditional view that if the government borrows more, interest rates are going to go up. When interest rates go up, people don't want to invest. They don't want to buy homes. That means we have less investment, less growth in GDP. We're poor in the future because we have less capital. And so high debt is basically, the view is stealing from the future. I'm happy to take some questions as we go. I see someone raise their hand. If it's sort of clarification questions, if you want to write it in the chat, that might be the easiest thing. But I just saw someone raise their hand. So if you, in this traditional view, so first of all, you crowd out private investment, and that's sort of bad for growth. And then also you're going to have this debt, and you're going to have to pay interest on the debt. And the way to do that is you're going to either have to cut spending or raise taxes to pay interest on the debt. So that means borrowing to finance, particularly current consumption, lowers future living standards. Now, the story is different if you're borrowing to finance investment, like infrastructure or education, because it's true that you are borrowing and have more debt, but if you're putting the money into a good investment, then that investment should yield returns that allow you to pay the interest on the debt. And we'll talk a lot more about investment in a few minutes. Okay. And then the other argument is if we keep increasing borrowing to finance consumption, interest rates will rise, we'll crowd out lots of future consumption, and eventually if we just keep on borrowing and borrowing and borrowing, no one's going to lend to us because we won't be able to credibly repay, right? So that is the traditional argument that would say, debt is a really big problem. Our debt used to be 35 to 40% of GDP. Somehow in just a short time, we've gotten up really in 10 years. We've gotten up to almost 100% of GDP with no end in sight. And, we better be careful with our borrowing and perhaps buckle down and not spend so freely, okay? This view just doesn't account for the very low interest rates we now see. Okay, so even though I would say interest rates have been falling for 30 years, economists kind of didn't really notice that there's this sort of secular decline in interest rates, except in the past, 5 to 10 years, where we realized, oh my God, look at interest rates, they've been falling. So these are nominal interest rates on 10-year treasuries. Oh, I meant to check what today's was and I forgot. This is pretty up to date. So you can see nominal interest rates are less than 0.5% nominal. What do I mean by nominal? That's not adjusted for inflation, right? So if I have to pay someone back next year and there's inflation, then I'm going to be paying it back in sort of cheaper money. And so you want to subtract inflation to get real interest rates to know what the actual burden is. And so with inflation, expected inflation somewhere close to 2%, you can see that real interest rates are actually negative right now, right? That means that you have to pay back less than you actually borrowed. Another way of seeing this directly is by looking at what are called TIPS. So TIPS are securities that are inflation protected. And so basically the promise is we will give you a real rate of this amount. Whatever inflation is, we'll give you that on top of this rate. And so you can see tip rates are close to negative 0.5%. Okay, so real rate, and these are for 30 years. I was showing you 10 before. This is for 30-year TIPS rates. That means the government can borrow for 30 years at negative real interest rates. And they can lock in a whole bunch of borrowing right now at these low rates, right? So this is just not the story where like, oh my God, we have all this borrowing and it leads to high interest rates and all this crowd out. The opposite has happened. COVID has actually led to even faster decline in interest rates. So we saw big declines during the Great Recession, then kind of flat, and then starting to decline again, and COVID made it fall even more. So this is just really a very big change in the way we think about interest rates and debt, and it's kind of required a paradigm shift that not everybody's on board with yet, but I think it is becoming more and more common to start thinking about, the old way we used to think about debt is perhaps not the best way. That's a good question. I see with low interest rates, why doesn't the Treasury fund our entire debt with 20 to 30-year bonds? So I am not a expert in debt management, it's complicated. They try to they got to minimize risk, and 30 years negative, but the short term is even lower. And also you're trying to think about when the Treasury supplies bonds, they're not just trying to minimize the cost, because Treasury bonds are a really, really important component for the economy. I'm sorry, that is my dog. So Treasury bonds are really, really important. And so you want to supply the economy with the kinds of bonds that people need, right? So some people really need a 5-year horizon. These are the safest, most liquid assets. Jays, I'm really sorry.
Sounds like your dog has something to say about T-bills and interest rates as well. I'm really sorry.
I had this great idea of having this office kind of in the hallway here, and it just doesn't work so well for webinars. I wish my dog had a mute button. Anyhow, so part of the reason is that when you think about how the Treasury issues bonds, there's a whole bunch of considerations, not just like let's minimize the borrowing cost, and remembering that taxpayers are on the other side. I have a hard time understanding negative interest rates. Negative interest rates just mean like if I borrow $100 today, then it's as if in real dollars, I only have to pay you back 98 in the future. So people are basically lending the government money and saying, I don't have to be paid back totally because I like the safety of putting my money here, and I can't get it, I can't do better elsewhere. I could keep it under my mattress, but then I might lose it, or it might be stolen. And so I am just going to put my money with the government and basically lose a little bit of money to know that at least it stays safe. Okay, so let's go on. All right, so how do we think about debt in a world of persistently low interest rates? So we think about debt as sustainable. We don't, when it is a constant share of GDP. So when you think about a household, like the best equivalent to debt is they get a mortgage. And when they get a mortgage, they typically think they're not only going to just pay the interest, but they're going to actually pay down the mortgage. So they're going to pay it off. Now they don't have to, but that is the way households tend to do it. And it's a forced saving, and they retire and they now own the house and they can live in it for free. But for a government who lives forever, right? We're always having new taxpayers. There's no real reason to pay down debt. What you want to do is make sure debt isn't on that course that I showed you before, which is increasing forever, right? So you want it to be sustainable, is you want to kind of say, fine, debt is maybe 100% of GDP, but as long as it's sort of staying there, that's fine, and we just have to pay the interest on it, right? So what is required for debt to be constant as a share of GDP? So what is required is that your primary surplus, what is that? That's the revenues that you get minus everything you spend on things other than interest, right? So you actually have to have a surplus. You have to have extra money to pay interest, but it doesn't have to equal the interest times the debt. It has to equal what I write down as R minus G times the debt. R is the interest rate and G is the growth rate of GDP. Why is that? Well, if we just want the debt to be stable as a share of GDP, then when debt increases, GDP can increase and debt to GDP ratio stays the same. So like as we get richer, our debt can go up and still not present any kind of problem. So that means that we don't have to pay all the interest. We just have to pay the difference between the interest and the growth rate of the economy, okay? So this R minus G debt dynamic is really, really important. Okay, I try to do a very simple example to show you how powerful R and G are. So what I'm going to show you here is what happens if you borrow $100 and make no payments on it at all. You don't make any interest payments, you just keep letting the interest accrue, okay? So in the top case, this is where R is greater than G. This is what all economists thought was sort of the natural state of affairs, and how we thought about interest and before the last 10 years, okay? So if you borrowed 100 in the first year and your GDP was 1,000, your debt to GDP ratio was 10%. You didn't pay anything off, the interest rate is 5%, so next year you'd owe 105. Your GDP only grew 3%, so your GDP was 1,030, and your debt to GDP ratio went up. So this is not sustainable. You have to make payments, and you have to make payments equal to 2%, R minus G, in order for that debt to GDP ratio to stay the same. In case 2, R is equal to G. The interest rate is 3%, and the growth rate of the economy is 3%. I do the same thing, but instead of the debt going from 100 to 105, the interest rate's only 3%, so it only goes from 100 to 103. The debt grows at the same rate as GDP, and so the debt to GDP ratio doesn't go up. And you didn't spend any money at all. So you borrow 100 and you never pay any interest. You just keep rolling it over and borrowing more to cover the interest, and still your debt to GDP ratio stays the same. That's the R equals G, when in some sense it says, well, debt was sort of free. I got the $100 to spend and I never had to give anything up. When R is less than G, that's case 3, if the interest rate is 2% and the growth rate of the economy is still 3%, right, then your interest is actually accruing not as quickly as GDP is growing. And so you borrow, you never pay anything. And it's not that the debt to GDP ratio stays the same, it actually falls. Before I showed you that we had a very high debt to GDP ratio after World War II, and then it came down really quickly. It came down really quickly because we had really rapid GDP growth, not because we spent all this money paying off the debt. So the really rapid GDP growth after World War II just made that debt to GDP ratio come down and seem quite manageable. So the R minus G dynamics are really, really important. This is a picture of R minus G. right? So this is the average borrowing on federal debt minus the growth rate of GDP. You can see that these things spike during recessions very temporarily, and that's because G falls, right? So when G was negative, as it was in the second quarter when GDP fell 31% at an annual rate, R minus G spiked up. But other than that, you can see, first of all, this kind of secular decline in R minus G, just like we saw the decline in interest rates before. If you drew a line, it would kind of look like it was going down. And then R is way less than G right now. And we have a very, very long period where it stays below G, 17 years where R is less than G, and then it's barely above it. And frankly, the reason it's going sort of up over time is CBO kind of assumes that, you know, we will eventually kind of get back to what we had before. We don't really understand why it's so much lower. And so they're saying eventually it will go up. But so this R minus G dynamic is really an important consideration. We're not just a little bit below G, we're quite a bit below, which means that debt is just not costly, okay? So, so if R minus G is less than 0, and if it would stay that there forever, you could roll over debt indefinitely by borrowing more to pay the interest, and the debt won't rise. So you could just keep borrowing. Now, and in that sense, debt seems free. You just keep borrowing and you don't have to pay anything. Now, of course, you know, the logic of the supply and demand for funds suggests that at some point, increased debt will lead to higher interest rates. We just really don't know what that level is, right? Most economists would have said when the debt went from 35%, which it was before the Great Recession, to 80%, which it was in 2019, you would have seen this big rise in interest rates, and instead we saw a decline. And the other thing to remember is the CBO projections that I just showed you of R minus G staying well below 0 for quite a long time are current law projections, which means they are already accounting for this rise in the debt under current law that I showed you before, right? If we didn't have this huge rise in debt, then interest rates would be even lower, and R minus G would stay lower even longer. But, you know, interest rates are really hard to project. I'm going to, in a second, tell you why, some of the explanations for why R might be so low, but the truth of the matter is we don't really know. And so you don't want to go all in on low interest rates and debt, just saying, oh, it doesn't matter, it will never matter, because rates could increase sharply at some point. And if we had this huge amount of debt and interest rates went up a lot, then we'd have to have some really, really hard choices. So you want to pay attention to the projections. The markets think that interest rates are going to stay low. Like most observers think interest rates are going to stay low, but you don't know, right? So you've got to kind of balance the risks. What are some of the reasons why R might be so low? So basically, as I said before, the interest rate is really what equilibrates the supply and demand for savings, right? So if R has been falling, it's because savings have been growing faster than the demand for investment, right? So lots of people are saving and not that many people want to borrow the money. They don't have great projects to do, and so the return on savings is very low. Why has this happened? Not really well understood, but some of the proposed reasons are demographic change, which lowers the demand for investment. If your labor force is not growing quickly, you don't need to go supply them with offices and laptops and capital. And also, as baby boomers are preparing for retirement, and people around the world, because this is a global market, there's increase of supply coming from demographic change too. There's been a move away from capital-intensive industries. If you think about manufacturing and you think it's all about equipment and buildings, and now so much of stuff is kind of not manufacturing based, much more human capital. That's not stuff you invest in the same way. So less demand for investment. Increased social insurance, again, here and around the world, sort of increased healthcare coverage with the ACA, for example, lowers the need for precautionary savings. If people know that if something bad happens, they're covered, they don't need to save as much for precautionary reasons. And increasing inequality. So when for any given level of GDP, when more of it goes to rich people tend to save more. And so that's going to lower that's going to raise the saving rate. So most of these reasons suggest that like R will probably stay low. It's not just this kind of near-term thing where we see reasons for it to go back up in the future. And so people think that R is probably going to stay low. Okay, so what are the implications? So when we talk about debt, right? All the traditional arguments about debt is that we can't have too much debt because we'll be hurting our children, right? It's like it's bad for our grandchildren. They're going to have to pay the bill. So the reason we worry about debt is we worry about future living standards. So the question is, in this really low interest rate world where debt is not costly, what is the best way of thinking about improving future living standards, right? So first of all, with this very low cost of debt, what we should do is do everything possible, do a very big fiscal stimulus bill to get the economy back to potential as soon as possible. I showed you that if the economy takes a really long time to recover, there is long-term damage. That means GDP will never be, or not for a really long time, where it would have been. That's just a very bad outcome. And so it's like an investment to say, let's get people back to work. It's good for us now and it's good for the future. You want to invest in things like education, health, housing, especially for poor families. There has been a lot of evidence in the past, I'd say 5 to 10 years, that because we now have administrative data that can track kids, you can say who got medicated when they were young in the 1980s and how well do they do when they're 30 years old. So there's a lot of data, a lot of research that now has these big data sets that say spending money on poor families, improving their housing, giving them health care, improving their education, pre-K, that stuff has huge rates of return. You might think of it as spending, but it really is investing. You want to invest in the things that we typically think of investment is. You want to invest in better roads, better infrastructure, cleaner air. Also has huge benefits in terms of both better health and better cognition and better outcomes for kids in school. And you want to invest in climate change resilience, right? So what you're trying to do is say, okay, should I pay down the debt or should I borrow and invest, right? These are all investments that are likely to yield much higher returns than the cost of debt, right? So these are great investments that will make us richer as an economy and as a society. And they also combat a lot of the other problems that we have, for example, climate change, rising inequality. And so I think that this is a unique opportunity. We've got really, really low interest rates. We've got a lot of good investments. We know what things work and what things don't. And this is a time to really invest in our families and in our communities. You hear stories that the worst story is, we can't afford to invest, right? And you sort of imagine a government who says we can't afford to remove lead from drinking water. If there is anything that has a huge rate of return, is removing lead from drinking water. First of all, it's just completely immoral that some kids are getting from their public water lead that makes their brains worse off and gives them much worse outcomes in education, in health, in earnings, in crime. And this idea that we shouldn't borrow to do something like removing lead makes no sense from an economic perspective. This is a great investment and we should just borrow the money and do it. And so, I'm just going to conclude. So the fiscal response to COVID has raised debt to GDP sharply, and debt's projected to continue rising in the foreseeable future. But despite this rise in debt here and around the world, because everybody has increased debt because of COVID, interest rates have continued to plummet and real rate interest rates are now negative. So, and looking forward, we expect interest rates to remain low and to remain below the growth rate of the economy for some time. This is the time to invest in our economy. Not only will this improve future living standards, but it can also help address some of our major challenges, which I already talked about. So that is my slides, and I'm happy to take questions now. Thank you so much for listening. Okay.
I'll just
How do you
remind
want
the
to handle the
participants,
questions?
if you guys want to put your questions in the Q&A, we already have quite a few there. You can see the questions that are there, and you can upvote those questions. And Ted will be reading the questions for you, Louise.
Okay, great.
All right, Louise, here we go. We've got, this question is from Don, and Don asks, do you think that possibly some workers with solid job opportunities have decided that it is better to stay unemployed, collect government checks, so they reject jobs, etc., and keeps the unemployment rate artificially high?
So that was the worry with the $600. Which is like, for a lot of workers, it was more than they were making on their job, number one. And number two, the kinds of jobs where people could go back, being a grocery worker or, you know, a service worker, were dangerous now. They were exposing them. So you might think, well, that was a problem. The evidence suggests that just didn't seem to happen very much. Now, part of the reason might be that they knew that this $600 was limited. It was going to end at the end of July. And so if you thought the labor market was going to be bad for a long time, you wouldn't give up the possibility of a real job for something that was time limited. The other thing is that if you are laid off from your job and then the employer says, okay, come back to work now, you actually are no longer eligible for unemployment benefits because now you're not voluntarily unemployed. You've been recalled. And so I think that that wasn't a huge problem. Most economists would say if you kept something like the extra $600 for a long time, that would probably be a problem. And I think many of the suggestions are like, of course, we'd rather just change the replacement rate. That's the value of changing the replacement rate, is that you don't make it more worthwhile to stay home than to go to work. But you hear about, like, maybe we should make an extra $300 or an extra $400 a week, just so that problem is mitigated a little bit. But I think the evidence suggests that wasn't a huge issue. And one of the things that you see is sort of wages for low wage workers. They were a little temporarily high. You know, Target raised their wages $2 an hour, but you didn't see this huge increase in wages, which suggests that firms were able to get workers just fine, and that the constraint was still not enough jobs, not enough people willing to work jobs.
Great, thank you. Okay, another question here. This is from Noah. And Noah asks, doesn't the debt also make the country more reliant on foreign nations investing in our debt?
Yeah, so I don't have the numbers in front of me. I think maybe about half of the debt is held by foreigners. Don't quote me on that. So there is this question about who's buying our debt. But one of the reasons that interest rates has been falling in the U.S. is because the U.S. debt is still viewed as the most secure, the most liquid in the world. And people are not particularly worried about all of a sudden people pulling out of the market because, even if like one country like China decided to pull out of the U.S. somehow as sort of an economic war, what would they do? Well, they take their money and they put it into another country. And then the people from that country could then move their money to the U.S. And so we're not really that vulnerable. It's a big global capital market. The U.S. is viewed as quite safe. And so I think as long as we're still viewed as safe, we are going to be fine. And it's just good to have this diversified market where people are holding debt from other countries and really the capital flows to where it's, best needed.
Great, good. We have another question. This is from Caroline, and she's asking, so are you attributing the decrease in interest rates to more savings or monetary policy?
So that's a good question. So monetary policy, what the Fed would say is there's this concept called R star. R star is what is kind of the equilibrium interest rate. When rates are below R star, the Fed is having easy money and being accommodated. And when they're above it, they're being tight. The Fed doesn't choose R star. It's sort of a fundamental part of the economy. So if the Fed had interest rates higher, we would have a really weak economy. So the Fed is trying to fulfill its mandate, which is maximum employment at stable prices. And what's happened is the interest rates that gets our economy to maximum employment has been falling over time, right? So it's not that the Fed has decided to push the interest rate really low, it's that it's been falling. And you can see that even though interest rates have come down and the Fed's had interest rates really, really low and zero-ish now, you don't see any inflation. Right? So if what was happening is that it was monetary policy kind of artificially holding interest rates low, then the economy would be operating above potential. It would be like this crazy booming economy. There would be no one else to come into the labor market, and prices would start to go up. And the Fed would then say, well, that's not fulfilling my mandate. I better raise interest rates. So I don't attribute it to monetary policy. I attribute it to the Fed responding to some structural changes in the economy.
All right, a question here from David. David asked, the perennial question seems to be, why should we assume the government will be more efficient allocating resources in this way rather than relying on the market to allocate resources for those instances?
So, I mean, when I think about the kinds of investment I'm talking about, right? So the market is not going to provide high quality education to poor kids. And there's sort of no way for, you might, in a view of the economy where everything works just like a model of hyper rational, you'd say, well, those families should be able to borrow to pay for, better schools for their kids. And then eventually, the kids would pay it off when they're older, but that's just not how our society works in it, so there's nothing the market's going to do to improve schooling. The market is not going to pay to get lead out of the pipes when it's already a government function to provide water. And again, anything related to poor families, like this is saying that redistribution sort of has social benefits. The market's not going to do that.
Good, good. Okay, I've got a question here from David. And David asks, if R is less than G, then the percent of our budget going towards financing the debt, interest payments, should decrease. Yet the percentage of our budget going to pay interest on debt year after year keeps going up.
Actually, so the percentage of our budget going to pay interest is pretty low right now, even though our debt is really, really high. It will increase over time because there's two things happening. One, the interest rates are low, but two, our debt is increasing quite a bit. But if it were not for these really low interest rates, the amount that we'd be paying on debt would be much, much higher. Now it's kind of below what it was maybe 10 years ago or 15 years ago. I should have put that slide in, I didn't, but it's pretty moderate now, does increase over time, but low interest rates have a huge impact on how much of our budget we have to put towards paying interest.
So there's a question from John. John is asking, how is the crowding out effect measured in dollar terms? So
I'm not sure we ever sort of measure the crowding out in dollar terms. We look at interest rates as sort of a measure of the price that's equilibrating the market. So we know what's happened to investment, but sort of how much of it, what you're asking out for the crowd, what you're asking for the crowding out effect is to say, well, what would investment have been if the government hadn't borrowed, right? And so there are probably estimates of that. They're probably not very good. You sort of need a model of how does investment depend on interest rates and what's happened to interest rates. And so you need your counterfactual. And so that's not something people really try to do. I mean, there are probably some research papers that do that. But we do know that firms were sitting on a lot of cash, buying back shares, not looking like they needed a lot of cash to invest. They just sort of weren't investing a ton. And it didn't seem like any rates were really, really low. So if rates were the issue, when rates fell, you would see that investing kind of go, boom, but it hasn't.
All right, I've got actually another question from Don. And Don is asking, at what level of debt to GDP do lenders in other countries stop buying our debt or lending to the USA?
So that's the question, right? We see that debt has increased to 100% of GDP. And if lenders were starting to say, we don't really want to put our money in the United States anymore, their debt's really high, you would see interest rates rise. That's what people would have expected, right? Both because there's crowding out and just because maybe the US wouldn't be viewed as quite as safe anymore. But that has not happened. It's fallen. So, economists don't know how high the debt should be, and part of it depends on, what the saving rate is in the country. So Japan has 200% of debt to GDP ratios and also very low interest rates, right? So I think what we've learned is that you can borrow a lot more. So because remember, the government has sort of two capacities. It has taxing capacity. So the probability of us defaulting on our debt for anything other than political reasons, right? We've seen like political stalemates that have, almost led us to default. But for economic reasons, there's huge assets, right? Which is that the government can raise taxes. So they're not likely to default on the debt. And the other thing is when you borrow in your own currency, which the US does, not all countries do, you don't have this possibility where all of a sudden, like, it can be a huge increase in the amount of your own currency that you have to pay for debt because you're borrowing in your own currency. And some people say, in the long run, you could possibly inflate away your debt if you needed to do that too. That would also make investors worried, right? They wouldn't want to think that they're going to lend to you and you're going to inflate it away. So the fact that interest rates are still really, really low, despite, what's interesting, it's not just despite the increase in debt we've seen, but it's despite the fact that it looks like debt's just going to keep rising and yet interest rates are really low, just suggests that the appetite for lending to the US government is really big. And interest rates are low around the world, right? It's not only a US story. There's a little bit of benefit in the US getting particularly low interest rates because people view it as a safe place to invest. But interest rates are low around the world because this is really a global issue of global supply of savings and global demand.
Okay, we've got to hear from Sherry. And Sherry's asking, will politicians be willing to lower deficit spending if interest rates increase and rise above economic growth rates?
So I think the answer is yes, because what happens is you've seen that in the past, that when debt starts to get high, it becomes a political issue. And then there's all this demand for sort of deficits, cutting deficits. And we've seen that multiple times. In the Clinton administration, they came in and said, it's really good for the economists for us to cut deficits. We actually had surpluses during the Clinton administration. And it was responding to high interest rates, and interest rates actually came down as they started to do that. So I think there is a political economy aspect to it, that if it looks like it's bad for the economy to have higher debt, then there's going to be greater demand for doing those things, to cut some grand deal. And I think it's that once interest rates start to rise, that's kind of how it becomes on everyone's radar. And it's the fact that interest rates have been so low that just makes it just hard to make a huge issue out of it right now.
We've got a question here from Lawrence. Lawrence is asking, the citizens buy much of the negative or low return debt. So are they not paying the cost of this approach?
So I think that low interest rates are not like a good thing, right? It seems like it's a good thing when you're thinking about government debt, but it means that there are just not great rates of return available in the economy, right? If what happens now is that all of a sudden there's a huge boom and there's like all this investment opportunity, then rates will rise, which will be sort of challenging for the government, but good overall for the economy. And so I think that's exactly the right way of thinking about it. Low rates means low opportunities for investment and getting great returns. It means it's hard to prepare for the future. It's hard to save for retirement. So it is the flip side, right? And that is actually one of the reasons that the government sort of needs to be like spending money, because if what happens is there's like interest rates are really low and there's no demand for investment and government doesn't spend money, then interest rates go even lower and the economy just gets smaller and smaller. And so this is like Larry Summers talks about secular stagnation. That's his name for this. And this is a condition where unless the federal government is actually spending money, the economy is not going to be able to, is going to kind of get smaller and smaller. It's like we're going to save more and more and more, and then output will be small. So that this is sort of a situation where we need the government to spend money to keep the economy going. And if you think about the fact that there are really good public investments that we've been underinvesting in, right? Investments have really declined. Public investment has gone down as a share of GDP for decades. We hear stories about like, put more money into the IRS. Right? The IRS has no money to even collect taxes, and it lets people, get away with, cheating on their taxes because there's no way to catch them, especially the richer people, because that's just so complicated. So that like funding the government at good levels is an investment that yields great returns, as an example.
We have a question here from John, and John is asking, how is what you are saying different from or similar to the new monetary theory?
So new monetary theory, or MMT, is sort of like deficits are always free and the Fed should just hold. I don't quite understand MMT. I think to the extent there is some overlap, right? Which is like, from a standard economic perspective, debt is really cheap right now and kind of free, and MMT says that as well. MMT has some theories about how the inflation should really be driven by fiscal policy, should respond to inflation. So it's, in terms of the debt, it's not all that different. But I think that if you look at the MMT models, they are a little, I don't know, they're either the same as standard economics, or they don't really make sense. But I don't really understand MMT, and I think, people talk about how every time a sort of conventional economist tries to look at MMT and say, so it's this and it's this and it's this, the proponents say, no, it's not that, it's something else. So we really haven't managed to coalesce and figure out what we agree on and what we don't agree on with the MMT folks. That's the truth.
All right, here's a question from Don here. Don's asking, could you give some examples of, quote, bad spending for improving the future living standards?
Sure. So spending that is just kind of leading to consumption without, to the maybe wrong people in some sense, not wrong in any kind of ethical sense, but if what's going to happen, you're just going to spend money in ways that are just like buying, services that are used up. So more restaurant meals and more, yachts and more, stuff like that is not going to help us in the future, right? Personally, this gets political at some point, but personally, I think, raising the deficit to have tax cuts for rich people, probably not great for the future. But with these interest rates this low, it's also not so terrible. And in fact, I think one thing that's interesting is many of us were not in favor of the tax cuts in the last tax reform, which, the Trump tax cuts, because the economy seemed like it was at full employment. And we thought this wasn't a good use of the money just to lower taxes on rich people who have already, inequality has been so high, it's just going to make inequality worse. But the truth of the matter is that was a fiscal stimulus that actually showed us that the unemployment rate could come down even more. I personally would have preferred the spending be on sort of lower income people who have suffered. But from a macro perspective, I think it actually turned out to show us something useful, which is that with more fiscal stimulus, the economy could operate even hotter than it was.
All right, great. Thank you, Louise. Okay, this will be the last question for our session here today. And this question comes from Carl. Carl says, I teach high school econ. What are 3 good resources to read, study, to stay current on economic issues?
So I think I'm going to promote Brookings. But I think that the kind of stuff that we put out on Brookings, we do a lot of things like that are explainers about, like, we had an explainer on how does unemployment insurance work, or blogs about, like, what did the CARES Act have? Not just me, but there's many people at Brookings and other think tanks as well, Center on Budget and Policy Priorities. Like, there's a lot of think tanks that put out things that are just aimed at not technical, but good economics that are going to discuss current policy issues. If you guys haven't all seen The Fiscal Ship, I'm going to promote that as well. It's a free game. It's a budget game that allows people to actually worry about the long-term budget outlook, but it teaches a lot of there's pros and cons of policies. So I think that those are really good resources. And then, read the Wall Street Journal, not the editorial page, for that kind of coverage, and newspapers as well. But I do think that think tanks are going to be the best place, and Congressional Budget Office, and the Fed put out a lot of really good explainers that are targeted at kind of sophisticated but general audience.
All right, great. Thank you very much, Dr. Sheiner. Really appreciate your time, and also everyone else for participating in today's webinar. Just wanted to remind everyone to please take a minute to give us feedback. There will be a survey that we'd ask that you, follow-up survey that you would complete. Also, as we said, there'll be a recording of the webinar and the PowerPoints posted on the FTE website. And then I would remind everyone to just please tune in to our webinar on November 12th, when we'll have Bill Bergman, the Director of Research at Truth in Accounting. We'll be discussing the difference between federal budgets and federal expenditures. So we hope everyone stays safe and healthy, and good evening, great afternoon, wherever you are. And thank you, Dr. Sheiner.
Thank you so much. Thanks for having me. That was really fun. Someone asked about the Brookings website. Is brookings.edu, and if you go there, you'll see lots of materials, and there's like a COVID section and just tons of materials.
We can make sure we put that on our website.
Okay, great. Okay.
Thank you, Louise.
You're welcome. Have a good night, everybody.
All right. Take care, everybody.